You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
Good morning, Jim.
Well, we've been taking a look at the markets, the Standard & Poor, the Dow, other markets I haven't even heard of. They're all going for record highs, it seems, this week. And I think you were mentioning a big mistake, though, that people make when the markets are hot like this is that they go all in and their strategic reserve is down to nothing.
It really is, and I can tell you from a psychological standpoint and from a practical standpoint, I think it's one of the worst things an investor can do. And I have to tell you, Jim, that it wasn't that many years ago that I was one of those people. When I had an idea or I thought the market had turned or was at an extreme point, I'd put every cent I had. If I had $1 left in reserve, that was too much. And if you're right, that's great, and you're a hero. But if you're not, it's very, very corrosive. And I think it's something that all investors should seek to not do, except in very, very rare circumstances.
Yeah, and I know that usually we take a look at what happened in the past, if there's been a recession or a depression, how the markets react for a certain time. And if you did that, say, over the last 80 years, you did pretty well. But now, since we had the banking crash in the U.S. and in the rest of the world in many cases, the rules of the game have changed. You know, the market is not semi-predictable, and like even the people who are really good at it, I say semi-predictable. Now people are sitting there that, well, is it time for a correction? Is it going to keep going up? Is it going to go down? Is it going to, is the bubble going to burst? Well, I think, the equity markets right now are, it's a unique creature we haven't seen before. It's kind of a hybrid of, an elephant, a donkey, and a camel. How's that going to behave?
You're exactly right, Jim. It is less predictable. The moves are more violent, and there's more intervention on the part of central banks, of governments, of major players, the high-frequency trading. All these things give us a different game, and yet in a way it's still the same because the market knows more than all of us. It's more powerful. It's even more powerful than central governments. The governments can affect the direction of a market over time, but ultimately it will express itself in the way that it most desires to do. And so our ability as investors is to try, when the elephants are stomping around, is to kind of stay off to the side, and then when they calm down and start walking in a line in a certain direction, is to get on board that and not be trampled in the process. So the rules have changed in a way, but human emotions haven't changed, and that's why I think it's so important for the investor to know themselves and to keep some money in reserve. And the last time we talked, I used the example of the general keeping a strategic reserve, and I think it's an excellent visual analogy to keep in mind in this regard. A general going into battle will normally keep a certain percentage of their forces back from the front lines. And they do this because they don't know exactly how the battle will develop. There may be weak spots in the line where the enemy is threatening to break through, and they will perhaps rush some of that strategic reserve in to fill the gaps. Also, their own offensive may go better than they expected, in which case they want to capitalize on that and bring those reserves into, if they've broken through the enemy line, to exploit that and maybe even win the battle and perhaps even the war. But a good general does two things. They always try to keep a strategic reserve, and only in very rare cases do they commit everything to the battle. And thirdly, once they've done that, once they've achieved that short-term objective, they pull those forces back out again and make them a reserve. And this is an exact analogy for us as investors. We keep a certain amount of money in the account, no matter how certain we are of an outcome. We use it to plug a gap, and a gap would be perhaps we have a stock that we love a lot. We know it's a good stock. It declines further than we expected. We buy some more on the way down. And this has been the case now. And the thing is now, for example, we have some very astute investors saying it's very possible that we'll have one more downside crazy drop before we shake out the very last of the weak holders before the precious metals mining stocks and prices turn around and go up. And we may not get that. We just don't know yet. But, for example, I'm not confident enough to put those last forces in thinking that this is the bottom. It may be. It may have happened last week, and prices are up strongly this morning. But we could still see that downward gap. And for me, I would rather miss that opportunity now and put everything in than keep some out in case it is going to be one lower move before we get in, because I have a good number of positions now and I'll still do well, but I also won't be committed and then watch this go down and not be able to respond to it.
You said some of the gold stocks and other precious metal stocks are doing better than they were a week ago.
They really are right now, at any rate. Some of them have gapped up on the open, which is a very positive sign. The volume's pretty good, but we need to see how things close. And the thing is, if a person didn't buy anything down into the weakness of the last few weeks and they're sitting on 100% cash, they're now starting to get upset. And the fear of loss is being replaced by the fear of missing out. And so they may be buying heavily this morning, and this may be the first of a number of days and weeks straight up, but we don't know yet. The point being, yesterday, the day before, the last couple of weeks, was a better place to buy than today because you're buying weakness rather than strength. And again, we've talked about this so much, you need to go against your emotions. After you've done research and you know this is a good stock, you need to buy that into a decline to make more money rather than to buy it into a big, sharp flagpole rise. You'll make less money and have more risk.
You said people, usually trade on their emotions, not always on the facts. How can you keep yourself from getting carried away when everybody says, look at the equity markets? Why are you bothering with precious metals when, the equity market is the hot place?
Well, that's true. The Dow is making nominal highs, not real highs. It's 20% below its real high from 10 years ago, but it is making a new high. It's well above 14,000, and all the cheerleaders are out there, and maybe it'll be 15,000 before the summer. Who knows? But the point is, there's a whole lot more risk now after it's been going in this direction for almost 4 years than it was when it was at 7,000. And so we look at the mining stocks, which are universally hated, and they're really down in the pits like they're going to zero. And we have people talking about the TSXV going off the board itself. So this is where the potential is. You go in and you find those diamonds in the rough, and you have to steel yourself. And that's why I've suggested listening to people talk like Frank Wiestra and Jim Sinclair and Rick Rule and Eric Sprott and David Morgan and a number of these people who've been and done, and they've gone in during this weakness and they've purchased the best stocks because they've done the research. And we can do the same thing, but we have to overcome our emotions and do exactly the opposite of what our emotions tell us to do, or we'll become, as Rick Rule says, roadkill by investing with the masses instead of being a contrarian.
Well, when you watch all the different business TV channels, they all seem to be pretty hyper right now. It's they're very excited about what they're seeing on the markets. And I guess after you've worked at a place for years and it's been dull, boring, and nothing but negative news, it is kind of exciting to see something interesting to talk about.
It is true, and we all want to be aboard a winner. And, but the thing is, we talk about mad money. Well, mad money, people go out and they splurge and things, but mad money in your account, it keeps the investors sane because they know that they can respond, and even if prices are going up and they have a position and they'd always like more, there's a saying, you never have a big enough position when the price is going up, and it's never small enough when it's going against you. But you know that you can respond. Maybe you go out this morning and you find a stock that hasn't responded yet that you know is a good one, and you pick some up. And so this gives you an opportunity. Last week was the PDAC, the Prospector and Developers Association of Canada show in Toronto, and it lasted several days. And it's really a trade show / investor show. So there are a lot of booths there and a lot of people that are not just company reps of these different mining companies and not just investors, but also people who produce the drills and the trucks and all the equipment that goes to turning a piece of property into a mine and into a producing mill. And so this thing was attended by between 30 and 40,000 people. I believe it's the world's largest. And there's a saying about what they call the PDAC curse. And usually in March of every year, the prices have been advancing for mining stocks for 2 or 3 months. and it gets to a certain crescendo, at least for the first part of the year at PDAC, and then prices drop the next week. Well, I'm thinking maybe this is the reverse PDAC curse, because things have been so horrible going into it, and there's a certain amount of unconstrained optimism there, as some people have reported, so that we could still see this final washout. But there's a whole lot less optimism from what I've heard by the people attended this year than normal. So we could actually have put in a major bottom prior to the PDAC here, would have a reverse curse out of it, and it certainly is something to consider.
Well, when we were at Cambridge House's investment conference a few weeks ago in Vancouver, the feeling on the floor there was pretty optimistic. Maybe in Toronto, people felt the same way. And 40,000 people went to that Toronto convention. You know, that's a sizable chunk of any industry.
It really is, and people like Rick Rule were walking around with their checkbooks in hand, literally and figuratively. They're looking for properties that they know because they did the research before they got there that are really good, and they'll walk up and say, look, I'll cut you out a check today to keep you going because I know you got a good property. All I'm asking for is shares and a full warrant. And they're getting that. And so you probably had M&A activity going on there, and it's really the place where a lot of business takes place. But I think that, we've been through almost 2 years of this, and whether we see that waterfall decline over the next few weeks, or whether the bottom is in, as Bob Moriarty and others have suggested, a major low has been put in over the last few weeks, I think that the very best miners and producers are going to give stellar returns over the next couple of years to people that had the courage to buy into this and add to their positions and hold on, because we're true contrarians, and I really think it's going to pay off. And it's just a matter, you have to have the courage, and you have to have the money, and you have to be willing to act after you've done your personal research.
Well, analysts have been saying that the automotive industry is expected to be strong for the next 5 years. If you're going to invest in precious metals, how about palladium and platinum, both necessary for automobile production?
And we've been talking about platinum and palladium since the spring of last year, when nobody was talking about it having any kind of a future at all. It went from a presumed supply surplus to a supply deficit of 8 to 10, 12-year lows in terms of the deficit. And while this was going on with gold and silver with their struggles and prices, platinum and palladium were building solid bases, and palladium made a new high for the move last week. So, it's really showing that when you are contrarian, you have the potential to do well. And I think you're going to see platinum and palladium keep moving higher. And I've maintained this for some time. I even wrote an article that was in the Prospector News about this, that I believe that platinum and palladium are going to give us a preview of things to come with gold and silver a few years hence. I think we're going to see a very, very strong platinum and palladium market over the next 18 months, driven by supply and demand issues. And those charts are going to look pretty similar to what we'll see gold and silver do down the line as they move into their own, blow-off phases. It's going to be really fascinating. And I know the risk is great out there for all these things, but I believe the potential is great too, especially for people who've done their homework, who have some money to deploy, and who are willing to act on the research that leads them in the direction that they believe makes the most sense.
Well, when gold and silver started to make their latest little drop, it was because, and I think maybe we talked about it, China and India for the last 5 years have been very strong on precious metals, not only investing as governments, but encouraging their citizens to invest. Do you think they're both kind of sitting there waiting to see what happens to this market? And
I would suggest, and we won't know for sure for a while yet, but we never know when it's going on. I would suggest that we're going to see over the next couple of months, when the data comes out and when they start talking, that they have been aggressive buyers into this decline. Not only the usual suspects, so to speak, of China and Russia, the central banks there, but also the smaller countries. We're seeing even countries like Kazakhstan, adding to their gold reserves, and South Korea. I think you're going to see a whole host of central banks that have been buying into this decline, buying from weak hands and adding it to their central bank reserves of gold, and also increasingly silver, because China has announced that it's going to start accumulating silver beyond what it's been doing of buying up all the silver it produces in their own country. They're no longer an exporter, and I think you're going to see them building a strategic reserve of silver too, which can add an exciting new dimension to the silver supply-demand story.
And that just reminds me, in Asia, we have North Korea making noises, going to what they call moderate alert, and it's saying that U.S. and South Korea and Japan are all going to gang up on them. Well, you know, whenever war strikes, especially in an area like that that has a huge impact on the world economy, that usually results in precious metals becoming more valuable, doesn't it?
It tends to, and we have the Iranian situation, which acts like it may be coming to some kind of a really major boiling point here. Who knows what it'll result in, war or partial war or whatever, but it brings uncertainty to the market, and Mr. Market does not like uncertainty rather. And so when we wait for certainty, that price has already been reflected, and so we have price risk. When we invest during uncertainty, then we have the potential, because there's information risk, and we can buy at lower prices, and so that's what we want to be doing. You know, Jim, I mentioned to you a few weeks ago that I'll be speaking at the Wealth Protection Conference in Phoenix. It's coming up. It'll be the first, I believe it's the 4th and 5th of April, and if any of our listeners either live in the Phoenix area or can get down there, I think they'll find it's a real interesting conference. It's a small conference of just a few hundred attendees, and there'll be a number of other speakers there, and I hope to see some of our listeners, because I'm going to enjoy speaking there and listening to the other speakers. And if you get a chance to go to the Wealth Protection Conference, please do so, and you can find out information about it by Googling resource consultants, and they'll help give you all the information that you need.
David, always a fine show. Thanks for being my guest. My guest has been David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. You're listening to HowStreet.com radio, and you can contact us at info@HowStreet.com. I'm Jim Goddard.